I was waiting for that cue where it usually says recording in progress, but thank you everyone for tuning in today to the Investing Bootcamp webinar hosted by Sarwa, where we're going to deep dive into the rules of investing. My name is Eamon Gebre, Head of Wealth Advisor here at Sarwa. A little bit about myself before we start. So I've been with the organization now just over a year, celebrating my 1-year anniversary in October. I've been in the region now, just crossing the 11-year mark. It's been an amazing experience so far. I've had the opportunity of working with many clients through Sarwa, also with HSBC, did a bit of consulting for a couple of years, and I worked for a bank called TD Canada Trust in my home country for nearly 10 years. And I'm excited to be here with you. And I'm also joined alongside my colleague, Daryl Hulse. Daryl, who needs no introduction, but please go right ahead and introduce yourself to everyone.
Thank you very much, and really a pleasure to be with you all this evening. I've been with Sarwa a little longer than Eamon, just over 3 years now, but I was very, very happy when he joined the team as our Head of Wealth Advisory. So we've been able to do a lot more with him on board, that's for sure, and we continue to expand as a whole company throughout 2022. So that's really exciting. But in terms of what I do, so obviously wealth management, events, assisting client with any financial planning requirements, strategy planning, and general Q&As. So we're here to support you if you're a client of ours throughout your investment journey, but I've always worked in finance. So my background is actually Forex. So for those who have any questions around the best way to transfer their money abroad, then I'm your gal. I can make sure that you're getting the best rates and recommend some providers, obviously no affiliation. So yeah, I mean, Eamon, just before we start, I think we've got some numbers building, but can you tell me maybe just something as a conversation starter about what you've been doing as a priority for the start of this year?
Oh, for 2022, and it's going to sound really cliche, but the whole idea of having a New Year's resolution, yeah, I jumped on that bandwagon, and I'm trying to stay fit. Actually, not stay fit, trying to be fit. So that's what I'm working on right now, making sure I go to the gym, run, walk, whenever opportunity that I get. We work predominantly remotely, so I'm sitting on my desk at home, 8 to 9 hours a day. So I want to make sure that I am being active and moving around. So that's my focus for 2022. And yourself, Daryl?
Very nice. It's a bit of a classic New Year's resolution. So I'll ask you again in June, midway through the year, to see how that's sticking. But for me, I think
you'll know anyways. If I gain a couple of kgs, I think you'll know by then.
Yeah, when I see you, exactly. But no, mindfulness, less screen time for me. That's what my focus is. So again, I sit at the screen all day, same as you. I'm trying to switch that off. But everyone here with us this evening, we'd be interested to see what yours is. We have a Q&A section at the end. There's a little chat box, so ping anything interesting in that you're focusing on this year. We're hoping that it's going to be starting your investment journey. If you're not already with us, this should be everyone's focus point. So hopefully we're going to have some great discussions with you all, get to meet and greet. So let's see what you take away from this evening.
Spectacular. And just as Daryl mentioned, especially for those who are tuning in for the first time into the deep dive seminar, there's a Q&A section at the end of this presentation where we'll be answering all of your questions, but you don't need to wait until the end to ask your questions. Feel free to type them in as they come to your mind. There's a nice little button on the bottom of your Zoom platform where it says Q&A. Just type the questions right into there, and we'll be happy to address them.
Yes, and we encourage you to do it along the way, otherwise you'll forget. We cover a lot of content, so let's do that.
Do you think it's a good time for us to start now, Daryl?
Yes, we may have a few late joiners, but we don't want to keep the rest waiting, so let's jump straight in.
Absolutely, and there will be a recording of this, as I mentioned at the beginning of this presentation, so you'll always be able to tune in at a later point if there's anything that you've missed. But without further ado, after you, Daryl.
Thank you. So a couple of just rules of house is that before we get into the 4 rules of investing, we want to make it very clear that nor Eamon or I can tell the future in the same way that you can't. We don't have a crystal ball in order to predict or get an outlook as to what's going to happen in the market next. Nobody does. So in that same way or breath, our views should not be taken as individual one-on-one financial advice. We're talking in very generic terms here. It's fundamental rules of investing that can be applied in generally, but if you are looking for that more personal touch, then reach out to us and we can go into a bit more granular detail about your own finances. So the importance that we have behind us, and the reason that we do these particular webinars on a regular basis, is because there's a lot of research out there in the region. What we're seeing here is actually a study that was conducted by Mercer. They're a global consultancy firm, and this showed that over 60% of people living in the UAE who attended the survey had no long-term savings at all. So we really wanted to make sure that we are encouraging people to get into this journey, whether you're young or old. You know, there's no better time than yesterday or tomorrow. But I think the past few years have really made people realize that things can change very quickly, and we need to have some savings set aside, some investments that we can fall back on in emergency situations, which we'll come to in a moment as well. So let's make this figure reduce.
Absolutely.
So why do we need to invest? This is a key question. It's really, really important to put your money in the markets and to make it work harder for you than just lying around in cash, whether it's under the mattress or in the bank. Why is this? Because of inflation. This is bottom line, fact of the matter, doesn't need to be overly complicated. I'm sure lots here with us this evening have seen the inflation hitting the headlines recently. You know, we've got inflation in the US at 7%, it's rising globally, whether it's in Europe or elsewhere, in the Middle East included. So this is why we need to make sure that we're staying ahead of the curve by investing. Inflation, very simply, is a general rises in prices over time. So that means that the income that we have today, whether it's in 2020 or 2022, is not going to have the same buying power in the future as it does after inflation. So this simple example that you're looking at on the slide means that $1,000 back in 2020, in 10 years' time, will actually only be worth around $780. So it depreciates in value. And so for everyone who's working hard to save their money, keep it in the bank, you know, we spend 90% of our life at work, well, hopefully not that high, but we do all of this work to put it aside, and then it just gets eroded by inflation. So
yeah, it's so relevant because, we see it day in and day out where a lot of individuals feel this sense of security having their money sitting in cash in their savings account. And, you know, they've gotten into the habit, don't get me wrong, of actually putting some money away for a rainy day, as what maybe our parents or our grandparents would have taught us back in the days, right? But the problem is that they're just not letting their money work as hard for them. So meanwhile, they've got this nice lump sum sitting in a savings account. Unfortunately, life gets more expensive. And as Daryl's mentioned, your purchasing power diminishes over time. So meanwhile, you know, maybe your retirement needs at one point in time may have been, you know, maybe, you know, an income of $5,000 per month is all that you needed. But, you know, 10 years down the road, you may really need about close to 6,000 or maybe higher just to be able to purchase the same items that you were able to purchase 10 years prior. So that's why it's so important to put your money to work.
Definitely. So as well, we wanted to highlight a couple of things that we should be doing before we even start our investment journey. So these are the foundations, if you will. Number one is to build an emergency fund. Why is this important? Because number one, it helps you to avoid debt. And number two, it also gives you a cash buffer to prevent you from dipping in and out to your investment portfolio when you do get started, because that can then be detrimental to your longer term performance, depending on where the market's trading at the time. So what does this look like? It should be really between 3 to 6 months worth of your fixed expenses. So whatever that figure looks like for you. And then this is just cash that's liquid, easily accessible, that you can use in the event of any unexpected expenses or emergencies. So it's just that nice cash buffer to have in the bank. In the same way, if you ever were to lose your job and be in that unfortunate situation, which many of us were not too long ago, you know, it happened very unexpectedly, this also gives us something to fall back on, again, without having to dip into that portfolio that we've worked so hard to build. Secondly, debt management is also of a fundamental focus. If we can avoid debt, then that's obviously the ideal scenario, but it's not always possible, of course. So we all aim to live within our means, I'm sure. And if we're using credit cards in the right way, then we can actually receive some good points, some good benefits and advantages, whether that's, I don't know, air miles, the lounge, cinema tickets, whatever they're advertising these days with the banks. But if possible, we want to stay within our means. If you do have debt, of course, then we recommend looking at what's called the Avalanche Method. So here you would eliminate your debts by paying off your accounts in order of the highest interest rate to the lowest. And this just helps you to get out of debt faster and pay less overall. But why you want to clear your debt down before you start investing is because if you're, well, number one, is that we live in one of the highest interest paying regions in the world. Interest rate fees are extremely high here. And if you're earning 5%, 10% on your investments, whatever it is, but paying the same potentially on your credit cards, it's just completely counterintuitive. So that's why you want to clear that down first, and then your money really will be working for you in the best way. As a final point, you also have the option to consolidate things. So this just means combining multiple high interest payments into one lower interest rate payment. It's just an effective debt management strategy.
Very well said.
And then, you know, lots of people don't know where to get started with how much they should be investing, what their spending looks like, and the needs and the necessities, could they be reduced? Potentially. So we use a very simple budgeting tool. We call it the 50-30-20 rule, whereby you would allocate 50% of your monthly salary towards the needs, the necessities, what we need to get by day to day. So, you know, this is our rent or our mortgage, our education for the children, groceries, healthcare, transportation, these general things. And then this varies depending on how much you're earning and what your preferences are, but typically we see that people spend around 30% of what they earn on themselves or their families, the things they enjoy. So whether that's clothes shopping, your Netflix subscription, or traveling, eating out, whatever it may be, this is the nice portion that you can go away and enjoy. The remaining 20%, this is for your savings and investments. So if you're just starting out, that's when you're starting to build your emergency pot. Once that's done, switch your focus to your investments. And of course, when you dip into that emergency fund, you want to make sure it's topped up right away or as soon as possible as well.
Absolutely. And if I can add one thing here, Daryl, I mean, assuming that you don't have any debt, or you don't, you already have your emergency reserve set aside and you can comfortably allocate 20% of your gross income, I would probably look at it in reverse, because all too often we've come across individuals who will save whatever is remaining at the end of every month. So meanwhile, they may not necessarily be keeping within their capacity, within the limit of 50% towards fixed expenses or 30% towards discretionary. They may only be able to save 5% or 10% at the end of the month because they haven't really been keeping tabs and they've just been saving whatever's left over. Try to do in reverse. And the reason why I mention that is it's natural. As as time goes by, your needs and wants will change, and the number of items that you've been purchasing in the past will significantly be lower than what you would be purchasing in the future. I mean, you may now have new hobbies, you may have more children, you may all of a sudden, maybe you would have a home and a mortgage payment. So it's important to prioritize your goals and maybe pay yourself 20% first and try to live within your means with the remaining 80%. I think that's a really effective strategy, especially as time goes by. You'll start noticing that the amount of money that you have left over, if you're not keeping tabs on it, will get smaller and smaller, just due to reasons like inflation, or maybe just your personal spending habits may change as well.
Oh, amazing. I'm so glad that you brought that up, because that is so important. If you pay yourself first, get it out of your account, you're so less likely to spend it. Otherwise, the temptation is too great. And it starts small, right? You think, oh, it's only 150 dirhams, oh, it's only 300 dirhams, or whatever it may be. But all of that mounts up, whether it's a cup of coffee, a dinner out, and before you know it, by the end of the month, everything's gone. You think, oh, okay, I'll try again next month. And it's just a vicious circle. So totally agree, get it out and see how you go. Also, budgeting tools or trackers, there's so many of them available, the apps. Make yourself accountable. I'm pretty sure 90% of us will be shocked at what we're actually spending our money on.
Absolutely. If anybody's ever looked at their bank statements, or whether it be their credit cards or their debit card statements, you're in for a shock. You'll be like, I spent my money where? What? Anyhow, on that point, I think it's, this is good. I mean, from a foundation perspective, I mean, I think this is key, just to ensure that you put a budget into place, you manage your debt obligations, have your emergency reserves. I think that's really important. I think now it might be a good time for us to jump into the first best practice when it comes to investing, and that is the importance, the key underlying here, importance of starting now. And Daryl, mentioned this already. She said the best time to start is yesterday. I couldn't agree with you more, Daryl, because of a little thing called compound interest. Something even Albert Einstein, in his wisdom and his success, even had an opinion on it where he considered compound interest to be the eighth wonder of the world. Well, why is that? I mean, something that we probably was mentioned to us in primary school or in high school, and we've never heard of ever since then. But interestingly enough, it makes such a significant impact in your overall financial health. Why is that? Well, let's take a look at an example, just to kind of illustrate how important compound interest is and the importance of starting early. Let's take, for an example, you have an investment solution in which it offers you two options. Option one is that your interest, or the profit that you're making every single year, or the growth in your portfolio every year, will be paid out to you like clockwork year after year on the same anniversary date. Okay, so in this example, let's just say you invested $10,000 and you had the option of having your interest being paid out every single year, which in this case equates to 5% per annum. So you can choose that solution where, yeah, that's great. Every single year, I get a guaranteed 5%. 5% on $10,000 is $500. I'm the greatest investor in the world. I've got passive income, right? And that $500 is coming in like clockwork. Or option two is, well, why not reinvest that $500, right? I mean, what are we going to do with it? How much, runway do you really have with that $500 in income that you're earning per year? Why not consider reinvesting it back into the same portfolio altogether? And let's extrapolate. Let's look at a 30-year timeline. Let's look at exactly what the outcome would be. Well, in scenario number one, in which you had the interest being paid out to you year after year, how much money will you have left over at the end of that 30-year timeline from your original principal? Well, if you guessed $10,000, precisely, you invested $10,000, you took all your profits on an ongoing basis, and at the end of that investment journey, you just have your principal back, $10,000. But suppose you took option two, which is that you reinvested $500 year one, year two, year three, in an ongoing basis until year 30. Well, guess what? That $500 being reinvested back into the principal, you earn 5% on that. The interest that you earned, or the profit that you've earned, you reinvested it back into the principal again, and then you earn 5% on that. This compounding interest actually equates to be a total of $30,000 worth of growth during that period of time. Your $10,000 accrued to be $40,000 simply because one, you started early, and two, you reinvested your dividends on an ongoing basis. And let's take a further example just to see how much of an impact time makes on your investments and how beneficial compounding interest is. We have two colleagues here in this example. One is Gina and one is Rena. Friends at the office, really close. They have chats every now and then about what they're going to do for the weekend, what their plans are for the year. Well, in this conversation, they talked about planning for their future and specifically talking about their retirement goals. Well, Gina and Rena agreed to put away $5,000 per year until they each reach the age of 65. Now, Rena is 35 years old, okay? That means that she'll need to invest for the next 30 years. So 30 years multiplied by $5,000, that's $150,000 in principal that she can contribute during her investment career. Whereas Gina, slightly younger, she's 25 years old, has the ability to invest for 40 years. So just a 10-year difference, not much, not even really that noticeable, but a 10-year difference between the two. Well, she's able to accumulate a portfolio principal of $200,000. So if you look at the difference, they're both investing $5,000 per year, but the total really equates to be about a $50,000 difference over that 10-year timeline in principle. Well, let's look at what would happen if we played out a hypothetical scenario where, let's just say they earned a total return or accumulated return every single year of 7%. Okay, so 7% like clockwork year over year is what they were earning on their portfolio, and they had decided or opted to reinvest their dividends, their profits year after year. Well, in the case of Rena, she was very happy with what she had. She actually managed to grow her $150,000 with compounding interest to a value of $508,325. For her, it was more than enough to be able to pay for her cost of living at that stage of her life, to enjoy a trip or two, and to be able to, just feel satisfied to know that she has a little bit of, nest egg to rely upon. Whereas Gina, same variables, only difference was that Gina's been investing for 10 years longer. That 10 years equated to be a $500,000 difference. Her portfolio grew from $200,000 to $1,093,681, simply only because she had been investing longer. And this is one of the key, messages that we share with our clients when we discuss with them, about their investment goals, their strategies, what they're hoping to achieve is don't procrastinate. Because procrastinating, unfortunately, will cost you in your returns in your portfolio. Your best time to invest is yesterday. Now saying that, we meet with clients with all different levels of investment experience. Some have gone through really, challenging, environments where the markets were very volatile, and some have gone through environments where the markets just basically have been on the upwards trend for as long as they've been investing. And we do try to provide context, especially with individuals who are apprehensive about starting to invest in light of market volatility that might be occurring at this point in time. And this time, as we speak right now, is very relevant. I mean, the start of this year till now, we've seen the S&P 500, the NASDAQ, the Dow Jones, and many other indices all throughout the world, basically going up and down. And year to date, at this point in time, we're in the negative territory. So that might cause some to feel a little bit uncomfortable. They'll think, maybe I'll wait it out. I'll wait until this turmoil, kind of subsides. The challenging part of that is going back to the whole ethos of starting early, because the problem is volatility is inherent to investing. It's not a matter of if, it's a matter of when. Markets typically will experience volatility at certain points in time. In fact, it's cyclical. These things happen. There's contractionary periods, and there's expansionary periods, and there will be market volatility during that period of time. But the cost of staying out of the market is significantly greater than investing and being exposed to this market volatility. And to kind of illustrate this point, let's look at, for example, this line chart, which highlights the S&P 500 price level all the way from 1927 till present day. And this green line basically represents how the market has reacted throughout all of these significant, events in history. We'll talk at the very beginning where we had the Wall Street crash, arguably probably the most significant event when it came to the markets themselves. We had the Great Depression, we had World War II, we had the Cuban Missile Crisis, of which it seems reminiscent of what's happening nowadays between Russia and Ukraine and the US and its allies. A lot of parallels there. We had the Vietnam War. We had the US economic recession in the 80s. We had the Gulf War in the 90s. For any of you who are within the region, remember it to be quite a scary moment in our history here within this region. We had the dot-com bubble. And for those of you who maybe have been born post the year 2000s, I'll just let you know now. So there was a point in time where the internet was the newest, hottest thing. And it was unheard of at that point in time, where websites alone, just website names alone, were going for multi-million, if not billion-dollar valuations. Companies like www.pets.com are worth, umpteen amount of money. And that was the era where, unfortunately, we experienced a very significant market crash, where from the year 2000 well until 2009, the S&P 500 were at a very depressed level during that period of time. We had the global financial crisis in 2008 and 9, Brexit vote. You start noticing, however, just in spite of all of these significant market events, events that that our parents or maybe even ourselves have gone through, and how significant they were and how they impacted markets, the market still trended upwards. Throughout that period of time, it did its ups and its downs, but for an individual who just remained invested, had a disciplined approach, did not let the market cycle or the market, contractions or expansions, impact their, their decision to remain invested, actually benefited by just remaining invested for the long term. And this is what the point of this chart is trying to show. So in summary, for best practice number 1 is plan and take action, meaning.
Hey,
hello?
Sorry, can we just go back, because I must just add a couple of things here, if you don't mind.
I was treating it like a phone call, like hello? Yeah, sorry, because I was in the zone, and yeah.
I know, I had to interrupt your flow. I'm so sorry, I know. But I mean, it seems so obvious when you look at this chart, right? I mean, it's so clear, it almost smacks you in the face with how obvious it is. But what I wanted to add is that when I speak to clients, when we're going through periods where it is significant, let's take the coronavirus, for example, people have this mindset as if we've never been here before. You know, the markets have never experienced this. We don't know what's going to happen. It's so uncertain. You know, I'm panicking. I'm fearful. Of course, and rightly so. It was a terrible time. But we also need to have awareness of things that have happened in the past. Just because it wasn't in our lifetime or our parents' lifetime or however far back it was, I can tell you we've been in, well, the world and the stock markets have undergone many, many pandemics, whether it's the coronavirus, whether it's the Black Death or the blue bubonic plague. Is that how you say it? Bubonic plague. You know, we've got cholera, Ebola, smallpox, you get my point. So whether it's this event or something else, another financial crisis, I can assure you we've likely gone through it before. It'll be almost unheard of if we hadn't. So just take that step back, do a bit of research, speak to your advisor, and make sure that, you know, we have that peace of mind before we let our emotions take over, which is so often underestimated when it comes to investing, because we get caught up in the moment. We have all of this news coming in that's often negative, and it leads us to make poor investment decisions.
Absolutely, absolutely. So that's why, you know, it's so important to just start now, start yesterday, latest start today, as quickly as possible. There's no such thing as a perfect time that's post-dated or, you know, in the future dated. The idea is that, you know, if you start investing now and think long term, you'll benefit from it altogether, because markets typically trend upwards over an extended period of time. Now, this leads us on to actually rule number 2, or best practice number 2, because, you know, as I said, we have conversations every day with clients, and, you know, we'll get them to the level that they'll start, but some may ask, well, I don't know where to go from here. You know, meaning I'm with you, I'm on the same page. I know it's important to start investing, but I don't know where to start. And to that we say, take an approach where you diversify. You know, diversification is one of those gifts that was given to us by a gentleman by the name of Harry Markowitz, who's a Nobel Prize winner, who coined the term modern portfolio theory. And the idea is that if you take an approach where you diversify your investments, you're able to actually reduce your overall risk, but still give yourself the opportunity for the upside when you're investing. And to kind of illustrate why it's so important to diversify and how much of a value add it is, I present to you this chart, which basically highlights the different asset classes and how they've performed over the last 5 years. Okay, in 2016, for example, small cap stocks had a return of 21.3%, which is really great. That's amazing. So had you been invested only in small cap stocks in 2016, your portfolio would be up north of 20%. Whereas if you were sitting in cash, for example, you were at the bottom of the list. You didn't really earn much. You had a total growth of 0.3%. Whereas if you were invested in real estate, you know, investment trusts or REITs, you had a very modest growth of 8.6%. Now, let's just say you repeated that exercise in 2017 and you said, you know what, I'm going to invest in small caps again. I like what happened in 2016, and I think the same thing is going to happen in 2017. Well, guess what? It did not repeat itself. In 2017, emerging market stocks were top of the pile. They were the best performing asset class in 2017 at a return of 37.6%. Small cap stocks, which were the best in 2016, were somewhere along the middle, around 14.7%. And don't get me wrong, a lot of individuals would be very happy with a 14.7% return. I know I would be. But cash, unfortunately, was still at the bottom of the list. 2018, it's like as if that somebody just took this chart and put it upside down, because at the bottom of the list in 2018 is emerging markets, negative 14.3%. Small cap, also close towards the bottom as well, too, at a negative 11%. And what this chart is trying to highlight and trying to show you is that any particular asset class, just because they had a very strong return in the previous year, doesn't mean it dictates or denotes that the following year will follow the same trend. Asset classes, especially the varying ones, will have different performances due to so many different variables, whether it be internal or external forces that cause the asset to perform in a particular way. So it's really hard to just pick one particular asset class and ride it all the way until your goals and ambitions have been met. The idea is you want to diversify. Why not invest in a basket of securities? You'll have a little bit of small cap stocks. You'll have a little bit of emerging markets. You'll have some high yield bond. You'll have some REITs. You'll have some large cap stocks in there as well too. If you diversify your portfolio and have a broad market exposure to all of these different asset classes, you're actually able to reduce your overall risk profile by doing so and still give yourself the opportunity to generate stable growth. A great way to do that, and this is one of the things that we do here at Sarwa through our Sarwa Invest service, is you can invest into something called an exchange traded fund, or ETF for short. An ETF, in a nutshell, is just a basket of securities. You have your stocks, you have your bonds, you've got your real estate, you're going to have your financials, you're going to have your telecommunication. You'll have many different sectors that you're going to be invested in through this one particular ETF. It's in a, to kind of paint a picture, a bigger picture is that if you were to try to invest in, let's just say, I don't know, 20 different companies. You'll have to conduct the research, need to have the capital, and you'll need to execute a trade on 20 different companies. Whereas you can actually find an ETF that does all this work for you, and you're able to invest directly into it, and it'll take care of the diversification for you. And to give an example, here we have two ETFs that we use here at Sarwa. We have VTI on the left-hand side, which is provided by Vanguard. And in this particular ETF focuses on the US market. And in fact, it has a broad market exposure to small, mid, and large cap companies within the US. So you really have a really good exposure to the entire US market by investing in VTI ETF. To give you an idea of the sector diversification, you'll have your healthcare. You'll have your technology, you'll have your consumer services, you'll have your consumer goods, you will have your oil and gas, you'll have your telecommunications, industrials, and financials. So any industry you can think of that is a representation of the US market will be included in the VTI. Trying to duplicate this yourself will take you a lot of time, a lot of energy, a lot of money, because with ETFs, at times you can invest for as little as $5, whereas if you're trying to independently invest in all of these companies, of which there's over 4,000, you need 4,000 multiplied by the share price of that particular company. So it's a great way to diversify using an ETF. They're also really great at giving you diversification across different geographic regions around the world. So IEFA, it's our developed market ETF that's offered through iShares BlackRock. This gives you exposure to countries like Japan, United Kingdom, Switzerland, France, Germany, Italy, Spain, Hong Kong, Denmark. What greater way to have a global exposure or global diversification than through the use of an ETF that takes care of all the work for you? Now, at Sarwa, we have two different approaches or two different services when it comes to investing. You have your traditional robo-advisory model in which we will go ahead and make an onboard your account and make a recommendation for a diversified set of ETFs. And we'll be able to manage all of the rebalancing, and we'll manage all of the dividend reinvestment needs that you need in your portfolio. It's a one-stop shop, set it and forget it, auto drive, investment methodology altogether. And that takes care of it because we are firm believers in passive investing. We're really more focused on spreading the risk while preserving returns. And what we do is we buy, we hold, we rebalance at the right time, at the right combination of complementary securities. So your investment experience, and to kind of use that image, is more Zen-like. Trading is also another service that we offer through Sarwa Trade. So we have Sarwa Invest and Sarwa Trade. So if you prefer to be behind the driver's seat, where you want to buy and sell stocks that you're passionate about, stocks that you've researched yourself, and you want to basically be the key decision maker in investing in capital markets, you can do so through Sarwa Trade. Now, one of the things that we've learned, through this experience, here in the region, is that a lot of these, external brokerages within the region typically have very high brokerage costs. So it's, more often than not, you'll be paying per trade, and also you'll be paying some sort of account maintenance fee on an ongoing basis, right? Now you combine this with, unfortunately, some individuals just are not successful when it comes to trading. Instead of going down the ethos or attempting to succeed at the ethos of buying low and selling high, turns out to be the reverse, where they're buying high and they're selling low and they're realizing a loss. And I think a lot of that has to do with the fact that they're trading on stale news. They're getting a lot of influence, their friends, their cousins, or whomever it might be, are basically influencing them on what to buy. And also, as I said, trading based on stale news. And this unfortunately causes a lot of anxiety with a lot of investors. And And so what we've done with Sarwa Trade is that we've ensured that we allow clients to be able to buy with no commission on the buying, no commission on the selling. We also allow you to be able to maintain it without any account maintenance fee or any inactivity fees for that matter. We do have a very smart app, where a smart market updates that you'll be receiving on a daily basis, where it just kind of gives you a good snapshot of what's happening with the market. But we made sure and ensured that you're not getting these pop-ups, all these, and I don't know the technical term of this, Daryl, but basically a lot of these apps nowadays, there's all these triggers and all these messages telling you should buy now, you should sell now. We believe in the opposite of this, and as a result, we've never built in this type of functionality in our Sarwa Trade app. So at least that way, your experience can be much more Zen-like. And in order to, I guess a good way to be able to reduce your overall risk when you're trading, because trading can be quite volatile at times. It can be, anxiety ridden because of the way the markets move. I think a good strategy to take is something called core and satellite. And the whole idea is that you consolidate the core of your investment portfolio to a passively managed investment vehicle. So for example, Sarwa Invest would be an ideal solution where you can maybe allocate 80% of your overall investment portfolio towards a long-term passively managed portfolio. Whereas 20%, which is dubbed satellite portfolio, can be used to trade. You can use that to invest in stocks that you're passionate about, and stocks that you're willing to put the research in and manage yourself. So at least that way, from a risk management perspective, you're not betting everything on the house, right? As they would say, you're not betting the house. I always forget that term. You're not betting on the house. How do you say that again? Anyway, you're not putting everything in, you're not risking your entire portfolio, right? You get what I'm trying to say. I'm going to let it go. On that note, I'm going to hand it over to Daryl, who's going to take on rule number 3, or best practice number 3.
Yes, thank you for all of the great information. So I'll be looking after how we lower our costs. This is super important because it has such a huge impact to our investment returns, as in the same way that really inflation does. So we want to make sure that we're looking after our costs. We're going to start with a simple slide on the different fees that we need to look out for. So there's so many of them, to be honest, and different investments have different fees associated with them. So it can become quite complex, complicated, unless you know what to look out for. And to be honest, some investment structures are designed to be that way so that they can charge more without you being aware. So it's really important to steer clear of the sharks, and how you do that is by building your own knowledge. So you might find that you sit across the table one day from a trusted provider, and you're speaking with this guy in a great suit with shiny shoes. He's saying, my advisory fee is just 0.5%, which sounds fantastic. Perfect. Sign me up right away, But then they forget to inform you about the layers of charges that are often written into the fine print, whether that might be, trading costs, fund fees or expense ratios, as we call them, entry or exit penalties, collection charges, commissions. So all of these things. And if you ask them for a full breakdown, they should be transparent with you without talking around the subject too much. You want someone that you can be direct with and that's happy to share this information when requested. So points to know that costs directly impact your investment returns. Hopefully I've drilled that into you enough by now. And then different types of investments have different costs. So whether you're investing in stocks, bonds, ETFs, real estate, or anything else, be aware of what's associated with them. Everyone with me? Great. Okay, so here we're just looking at a simple example. It's hypothetical, but just to demonstrate how much these kinds of high fees can eat into our returns. If we focus on the first bar on the left, what this is showing you very easily is how a $10,000 portfolio would grow if it had 0 costs over a 30-year time frame and was earning around 7% per annum. So very reasonable. And we can see that we'd end up with a nice $76,000 in earnings. This is dreamland because unfortunately we do have to pay a service fee to the provider that we do opt for. So let's take a look at the other examples or scenarios. Just to let you know, as a benchmark, we should be aiming for around 1% as a target. Typically, anything above 1% is avoidable. So keep this in mind with whom you're speaking to, and it's often negotiated down. So as we can see, if we focus on that 1%, then this charge would equate to a monetary cost over that 30-year time period of around $18,700. This sounds like a lot of money, but if we compare this to someone who's paying much higher fees, let's say 4.5%, which is at the end just there, and we do live in one of the highest fee regions in the world when it comes to investing, we can see that the difference is significant. That 18,700 almost seems like nothing. It's negligible if we consider that we're actually giving away over 50% of our potential profits to that provider if we're paying closer to the 5% mark. So fees actually compound as well in the same way that our returns do. And if we don't lower our costs, then we could lose out on a significant amount of growth. Again, this is just demonstrating in another format that sometimes this discrepancy isn't always so noticeable either. So that was quite an extreme example I just gave you. You know, we're talking about 1% versus 4.5%, which hopefully most of us would realize and cotton on to before we signed the paperwork and started that investment journey. So when you are maybe comparing two portfolios, you might only be looking at a difference of 0.5%, or in this case, 1%. So you think maybe that can't have that much of an impact, right? So here we're looking at two identical portfolios, both assume an initial investment of $50,000 and a 7% annual return again with monthly contributions of $1,000. The only difference is that one is incurring fees of 2% and another at 0.85%. So that's actually 1.15% difference in fees. So in the same way as we did before, if we compound that forward in monetary terms, because that's easier for us to understand, we're actually paying over $300,000 in fees alone. And I'm pretty sure that anyone who came to you and said, you know what, actually this product is going to cost you $300,000, we'd run for the hills. And I'm sure we'd all much rather keep that really truly transformative piece of wealth in our own pockets to go away and enjoy in the future. So really, guys, stay, what's the word I'm looking for? You know, be aware, stay tuned to this kind of thing and make sure that you're not overpaying unnecessarily. So very short and sweet rule from there. I don't think we need to pay much more. Just remember that 1% benchmark. Now, emotions. This is another very interesting aspect when it comes to investing, because too often we let them get the better of us. You know, we are human by nature and we're designed to be emotional so that we can have empathy and passion and excitement and sadness. But this can also be very detrimental if we let it get on top of us when it comes to our decision making. And it's hugely influential, so much so that most of us don't realize it. You know, it happens without us even thinking. And before we know it, we're 2 months, 6 months, 10 years in, and we're making all of decisions that are not where we want to be. So as we can see here, much more money has actually been lost in the markets by investors trying to anticipate corrections than what was lost in the corrections themselves. What do we mean by this? If we take a study that was conducted by Morningstar, if you want to check it out yourself, you can Google, it's called Mind the Gap. But what this is showing is that the average investor earns below what the average market return is. So if we look back at the global stock market average, the S&P, typically we see an annual return of between 8, 10, maybe 11%, depending on the time frame. So if we look at a fund here, and this example is the S&P, I believe, over a 10-year period from 2007 through to 2017, which of course did include that 2008 financial crisis. So there was a big move down. Equity markets actually dropped around 50% at that time from their peak. And we found that despite this, the fund itself netted at the end of the period just under 4%. So compare that to the investors that were investing in that time, they actually experienced a loss of over 15%, which is a substantial difference, almost 20% in comparison to the average market gain. And this really happened because the investors didn't stay the course. They lost sight of their end goals. They got caught up in that recent market movement. They listened to the news and all of the doom and gloom that was happening, and they let their emotions take over, which is what we're discussing right now. Had they stuck to their plan, you know, at the beginning of their journey, they might be very optimistic, excited. They're saying, I'm working towards my retirement. And to do that, I'm going to 100% every month put away $500, $1,000, whatever it is, regardless of what the market's doing. Had they stuck to that plan and invested as the market moved lower and took advantage of those lower price points, when the recovery happened, they would have actually seen a nice boost to their investment return. But that didn't happen, and as a result, they ended up in the negative. So this is a really important education point this evening that we should take away. Volatility, again, isn't something to be afraid of. If you know how to take advantage of it, it can be hugely beneficial for your overall performance. If we move to the next slide, so what tends to happen is that investors often invest based on greed or fear. These are the two primary emotions that we experience. And we tend to buy in when markets are moving up because our friends are doing well, you know, our colleagues are telling us about this investment, that investment, and we should get in because it's skyrocketing at the moment. And we think, great, everyone's making money. I want to get me some of that. So their optimism starts off very well, but then as the market enters that price point where maximum point of financial risk, because that is what's happening as you're buying as it moves higher, it will take a turn and we're going to experience that dip. And all of that initial excitement goes away and that emotion turns into fear, denial, anxiety and full-on panic mode if it continues to move lower, 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 lower. You know, and if we're entering at the peak, then of course you're going to experience higher losses because you're not dollar cost averaging, which is another point we can come to a bit later. So our expectations plummet along with the market, but if you are investing on a monthly basis, sometimes you're going to be buying in when things are higher and other times when it's lower. So the volatility isn't going to hurt you so much and you'll spread your risk over time. So this is super important to have a strategy that works for you and your financial goals. One other thing I like to highlight here is that as investors, what we want to be doing is buying low and selling high. Too often we do the opposite. We buy low and sell. I've lost my train of thought. We buy high and sell low, and make sure you want to flip it on its head because, you know, stocks are no different to buying clothes or shoes or airline tickets when they're on discount or sale. We need to take the same principle when it comes to our stocks. Buy at low prices. A big driver to why we make these poor investment decisions is when we open the morning paper or the website, Bloomberg, whatever it is, when we're reading our coffee or chatting to our friends, you know, the market's moving in this direction, the market's moving in that direction. We've got inflation, Russia-Ukraine conflict, coronavirus, hike of interest rates, you know, these constant informations that are bombarding us every single day are just causing us to be overwhelmed. We're overstimulated. We don't know whether we're going up, down, left, right. And it just all becomes irrelevant at the end of the day, because what we should really be focusing on is not what's happening last week, next month. It's our financial goals. What we really care about as investors is looking after our future selves. So if we keep that in mind and don't let our emotions overwhelm us and start reacting to the short-term movement, trying to think we're smart and we can implement these complicated trading strategies that we know what's going to happen next and we can time things, you know, honestly, simplify it, have an investment plan in place, use your advisor to develop it, and focus on your end goals. Ignore everything else, because out of that you hear that might actually be useful is minimal. So how do we control our emotions? What you're hearing me say is, you know, emotions, this, that, but what we need to do is just have a bit of logic, maintain our rationale, and not listen to our immediate gut reaction and make a rash decision that we might look back on and regret in hindsight when things don't materialize as we expect them to. So number one, when things seem to be getting out of control, maybe markets are swinging wildly, we're going through that period of high volatility, take a deep breath and don't panic. Block out the noise, as we've just mentioned, and focus on your end goals. Also, stop checking your portfolio. This is a very simple, easy tool to implement. You don't need to check it every day if you don't need that money for 5 years, 10 years, or 30 years when you retire. Honestly, this helps to eliminate so much more of our emotions because you're just not getting that in front of you as well. Risk level is also an important factor. If you're already investing with Sarwa and this is on your mind, please reach out to us. It's really important to make sure that you are investing in something that you feel comfortable with and allows you to maintain that regular contribution. If you're feeling stressed or anxious, you may need to tailor it. So speak to your advisor, use us, and remember that investing is like a bar of soap. The more you handle it, the smaller it gets.
Absolutely. And I'm just conscious of time because I want to get to the questions here, Daryl. So, I mean, in summary, what should we be doing?
So very simply, as a summary to what we've covered off this evening, we want to start. Simple as that. Get yourself in the market and diversify your portfolio. ETFs are the best way to do this. So whether you choose Sarwa or anyone else, maybe look at this as an option. It's very low cost as well, which, as we know, we want to control. So 1% is your max target. Everything else can be avoided. Don't be emotional. Block out the noise. Speak to your advisor.
That's, I mean, very succinct, very, very succinct. As far as what we do here at Sarwa, for those who are new, we make it very easy for individuals to start early. We are a completely digital experience where you're able to complete the registration within and under 15 minutes. We help you diversify your portfolio. What we do is we help to understand a little bit more about you. We want to understand your goals, your ambitions, your appetite for risk, your preferences, and we'll provide you a recommendation in line with your needs. Thirdly, we offer lower cost solutions than our competitors, and by significant margin. To give you an example, if you're just starting out and you're investing, anywhere between $5 and $2,500, you actually get to try out Sarwa for free for a year. So long as you haven't passed the $2,500 threshold or you haven't passed the 1-year mark, you can enjoy our services for free for a year. And the moment that you do pass that threshold, our annual fee is 0.85%. That's up to $50,000. And the moment you pass $50,000, you start receiving discounts on your pricing. So it turns into 0.70% per annum. And if you pass the $100,000 threshold, it becomes 0.50%. Now, keep in mind, these fees are not charged upfront. They're actually charged on a pro rata basis. So on a monthly basis, you're billed for the time that you spent with us, and it's calculated down to the day. So if you've been with us for 15 days that month and you decided that this is the service for you, you're only paying for 15 days worth of service. Lastly, about not being emotional, you can always reach out to advisors like myself or Daryl or any other members of the team. And we also have a spectacular customer support team that you can reach out to all the way from 9 a.m. until 1 a.m. in the morning. So feel free to reach out to us. And regarding Sarwa Trade app, as we mentioned before, it's a zero commission trading platform and the zero transfer cost when you're funding in dirhams because it's local funding. You're able to buy fractional shares. So you don't need to actually, invest, the equivalent of whatever one share is worth of Google nowadays before they do the stock split. There's no account minimums. You can start for as little as $1 and you have access to over 4,000 stocks and ETFs within the US. So on that point, I think it's a good time for us to take some questions. I think it's arguably my favorite part of the webinar. So let's do it. Let's jump right in.
Well, I was just having a look as you were wrapping up there, and to be honest, we haven't had a huge amount. So guys, please, if you're still with us, number one, thank you so much for staying with us. And I really hope you enjoyed the session and that it's been useful. It's something you can take away and implement. But if you have questions, then please drop them into the Q&A. We'd love to get them addressed to make sure you're not left with any question marks, whether it's related to the initial content, the foundations, or Sarwa itself. Let's get it clarified.
There's one here by Anonymous, and they completely understand if you feel comfortable being anonymous. It says, Sarwa is new. How can we trust it? And it's an honest, fair question. Although I don't know how new we are anymore. I mean, we've been around since 2017 now, so we just celebrated our 4-year anniversary. During that period of time, which started off with just the 3 co-founders, we're now at 50 plus employees here at Sarwa. We've got over 60,000 registered users. We're backed by the region's strongest regulators. So we're regulated through the DIFC, by the Dubai Financial Services Authority, also through the ADGM, Abu Dhabi Global Markets, and that's the FSRA, Financial Services Regulatory Authority. And including, I mean, considering our backers as well too. So our shareholders would include individuals like Sharuk. You're looking at 500 startups. You're looking at Mubadala, who's our recent, VC, who's jumped on board to take ownership within Sarwa. So, I mean, I think I understand where you're coming from, but I think it's just like a matter of just trying us out, see the experience for yourself, and you'll realize really quickly as to why we stand out and why we've been growing considerably over the last few years.
And also, you know, we do feature in the press regularly, whether it's related to our fundraisers, which we've done extremely well with, like you say, Eamon, the big names that are backing us, they believe in the growth and what we've been doing over the last 4 years, but also from a customer perspective, there's news articles out there. So you just need to Google Sarwa and you're going to have plenty of positive feedback to help give you that peace of mind. Plus 90% of our business comes from referrals. So take advantage of that. If you know anyone that uses us, make sure you get that nice $50 bonus for yourself and your friend as well.
Absolutely. And just like in spite of that, okay, let's just say, you know, those things are great to know. But at the end of the day, I mean, the risk that you're looking at, I mean, there's market risk and then there's counterparty risk, or, you know, I guess risk on your provider in itself, right? So market risk, it goes without saying, nobody can control that. Markets are volatile, they can go up or down. But when it comes to risk, you know, of counterparty risk or the provider risk, for example, I mean, at the end of the day, these assets are your assets and they're segregated from Sarwa's assets. So regardless of whatever happens to us, it makes no impact or any difference to you. So if we do decide maybe a few years from now that maybe we're going to venture to another business avenue or whatever it might be, the great thing is that these assets are all delineated, they're all segregated, separated, and you always have the ability to withdraw your funds or transfer your assets to any institution at any point in time. At the end of the day, we're working with platforms such as Saxo Bank or Interactive Brokers, and Alpaca, also on our Sarwa trading platform itself. And they also have a number of guardrails that are already in place to make sure that if anything happens to them, your assets are still secure. There's always the use of a third-party custodian, which in most of those cases is going to be Citibank. So there's a lot of guardrails there, and I hope that gives you a little bit of comfort in hoping that will get you started with us.
Great, thank you so much. I'm just going to address Ahmed's question, if you don't mind, Eamon, as we had a little chat whilst we were presenting as well. So you may actually have some clarity to provide, because I was asking Ahmed whether he meant that HLAL ETF, which is the Wahed fund, and it is USA Sharia compliant. But Ahmed, this isn't something that we include within our Sarwa portfolio. So perhaps you're referring to the halal portfolio itself, which I'd be happy to give you more detail on. But I'm not actually familiar with the halal ETF as an individual fund. Eamon, are you?
No, is it halal or halal? Because I'm just reading the question now. It says HALA ETF. I'm not familiar. Halal.
Yeah, if you could just share some clarity, or maybe the link, Ahmed, that would be helpful, because like I say, we can go into more detail about the halal portfolio that we offer, but I don't want to do that if that's not what you mean. Otherwise, if it's HLAL, that's a Wahed fund specifically.
Got it, absolutely. And look, at the end of the day, so we have a halal portfolio here at Sarwa. Yes, you're absolutely correct. And we're using the iShares BlackRock portfolio of ETFs that give you access to US markets, emerging markets, and developed markets. We also have a Sukuk that's provided by Franklin Templeton, and we also have a gold ETC that's a part of the portfolio. So you have these 5 different funds that are Sharia compliant. The certification that allows you to be able to invest based on your values. So yes, we do have a halal portfolio here, but again, I'm not familiar with that one, if I understand it correctly, if that's what the question was.
Yeah.
Yahya, let me read this question here. I'm pretty new to investing, would like to start with an amount of 1,000 to 2,000 dirhams. Would it be advisable starting as a starting step, or should I start with a larger amount, say 10 to 20,000? And this is a lovely question. It's a good one, because I think it's a whole debate between lump sum versus monthly contributions, right? So, and I think it's important to kind of give a little bit of context here, right? So if you're in the position, meaning you have the capacity where you have excess savings beyond your emergency reserves, and you don't have these funds promised to any upcoming expenses or any other ventures that you have in mind, in a sense, as idle money, the best practice is to put this money to work and invest it. And in fact, supplement it with a monthly contribution. the whole idea of investing is you want to invest as soon as possible or early as possible and as often as possible. So if you have idle reserves and it's not doing anything in your bank account, which we know it's not, because interest rates are quite low, if not non-existent, the idea is that you want to invest as much as you can, as quickly as you can.
Great. Eamon, I'm going to take a couple of questions together, one from Pradeep and one from Linda. So thank you so much for those. Pradeep, I see that you are one of our existing clients that has a question that's personal to your portfolio with us. So I recommend if you can reach out to myself or Eamon tomorrow, we would be happy to get on the call and go through that together. I think that's the best way forward rather than discussing it with all of this with us this evening.
Okay.
And then Linda, thank you also for yours. She is asking what will happen with invested money if I were to need to move to another country. So this is also very important and a great question to have because we live in a very transient region. In the UAE, we're all expats, or the large percentage of us are, and quite likely we'll either go back to our home country at some point or move on elsewhere. So the great thing about Sarwa is that we are a global entity. So this means that we operate in almost all of the countries worldwide. So we have some limitations like the US, for example, and some other high-risk jurisdictions, but largely you can take us with you if you were to relocate. The platform itself is 100% online. You can fund, withdraw to any bank account in the world as long as it's held in your name. Of course, with that said, there are a couple of side notes that we have to mention, like tax and overseas transfer cost, currency risk, these general things. So if that is something that you have in mind, do let us know in advance so that we can have that discussion and make sure that we're supporting you in the best way possible and hopefully maintain the relationship once you leave the region as well.
Absolutely. There's a question here about other robo-advisors within the region and what makes us different. I'm happy to take that on board itself. Of the robo-advisory companies, the ones that come to mind, for example, is Stashaway. I believe CBD also is still running their robo-advisory service. I believe it's called the Investor app, INVESTR. I can't think of anybody else who's still around there. I don't know if anybody else comes to mind, but in a nutshell, anyways, well, number one, we were the first. There's no question about that. And being the first, you get to have really, on the ground experience with what clients want within the region, and you're able to kind of, cater to your consumer base with services and products that they want. And we feel that we have a really great pulse on the region here in itself. Our core focus is within the GCC, and we're domiciled here as well. Our entire operations is here onshore. So whether it be our customer support team, our advisory team, operations, accounting, etc., we are a homegrown company. We're here from the UAE, and we're very proud of it. Thirdly, it's been renowned over and over again that our portfolios have pretty much outperformed our competitors, and that's not because of our decisions on how we manage the portfolios per se, but it's more or less our strategy at the core itself is passive. We believe in it that passive investing is the ideal route to take when you're looking to invest for the long term. And time has been very generous in that regards, because in comparison to our competitors who take a little bit more of an active role, which has been shown to include some biases when it comes to investing or whatnot, we've seen that our portfolios have tested well over time. Our customer support team, very renowned. If anything, don't take my word on it. Go to our Google reviews, go to any other third-party reviews, has come back over and over again as having one of the most outstanding customer support teams within the region. And that's not even in comparison to other robo-advisories. I'm talking about cross industries. We train well, we hire well, we give a lot of resources and attention. And because if we take care of our employees, it means that they'll take care of our staff. And we're very passionate about that here. Lastly, I'll just mention this also from a pricing perspective. We're very black and white and transparent on the pricing, where if you hit those certain thresholds, you're automatically reduced to the lower price. So if you pass the $50,000 mark, you're automatically reduced to 0.7. And once you get past 100,000, you get dropped to 50,000. A lot of our competitors tend to use a more of a blended cost strategy, whereas if you're below a certain threshold, you'll always pay that much. And if you're above this threshold, you'll always pay that much. It's only for the top portion of your investments that are above the top threshold that you'll receive a discount. But at the end of the day, when you do the numbers, and also factor in the choice of ETFs and the expense ratio with the ETFs, we tend to be the winning formula. I did talk long there. Do we have maybe time for one more question? I know we're well over time here. I've been going on the Q&A. Maybe there's one question here, and I think it's a little bit more of a general aspect of things. And I hope everybody's still online with me and nobody's dropped. But there's a question here that says, what level of risk do you recommend? Is a choice of growth too dangerous? And I mean, that's very subjective. And this question was posed by Anonymous. It's very subjective because at the end of the day, every individual has their own goals and aspirations and timeline. And timeline is key, and your appetite for risk, meaning that what are you able to stomach during that period of time? There's some individuals who don't really care if they see market volatility, but with some individuals, the moment that they see even a 0.10% variation in their portfolio, they get apprehensive and they get uncomfortable. So it's very difficult for me to tell you as a general what's the best strategy to take. What I do recommend is, number one, try our website, register. It'll actually give you a recommendation on the spot. It doesn't cost you anything, right? So if you go through the recommendation where it'll ask you a set of questions, help us to understand a little bit more about you, and it'll give you a very customized recommendation according to your needs. And I think that's a really great place to start. On that note, I think I've already lost Daryl, and I hope our battery didn't die on our laptop. But folks, I wanted to say thank you very much for joining us today. And we do have these webinars on an ongoing basis. If there's any questions that haven't been addressed, don't hesitate to reach out to myself or my team here at Sarwa. We'll be more than happy to welcome you and address your queries. You can reach out to us through WhatsApp. You can reach out to us through chats, whether it be on your Sarwa dashboard or whether it be on your app. You can always email us, or of course, you can just old school call us as well, to whatever your preferred method. On that note, we wanted to say thank you very much for joining us. You have yourself a wonderful evening, and hopefully we'll catch you on upcoming webinars. Cheers.